All right. Well, good morning, everyone. Welcome to another edition of our Real Estate Backstory. Today's October 19th, and we're going to be going over, just a ton of stuff. We're going to be talking about the new normal. And then also, we are very blessed to have Melissa Christian and Nancy Barlow with us today. And I'm going to put them on the hot seat. So we're going to be covering, well, okay, it's not going to be that bad, but, we do have some pretty cool questions that some of the agents have had. And so these are some questions I'd like to kind of cover with you guys as well this morning. Before we get into that, I just want to cover really fast what's our continuing education for this week. So we have our accountability on Tuesday. Also on Tuesday, we have weird contract forms, agency exhibits, and amendments. On Wednesday, we have a fair housing class, as well as building a CMA with Paragon. And then on Thursday, we have another Paragon class, introduction to transaction desk kind of thing. So that is going to be what we have this week. So I'm going to kind of jump over into, so again, I'm very blessed to have Melissa and Nancy with us today. And so I've got a couple of things I kind of like to hit you guys up with. And so first thing is mortgage rates hit a record low for the 10th time this past week. What's going on with rates? Where are you guys at right now as far as, what do we need to be, what do our buyers need? Are we at a 600? Are we at 580? Are we at a 640? Are we at 750? Right now we're seeing that mortgage rates continue to drop, and I didn't think we'd be able to drop any more already. And the fact that we're at a 10th record low, it's kind of like, how low can you go? So kind of brings up to speed on kind of what's happening out there on the rate side of things.
Well, that's it. Yeah, you're correct, Alan.
All right, you got to get a little closer because I'm having a hard time hearing you. So
yeah, the market has been really low and so forth, and we're looking for a little while longer, of course, till after the election. A lot of it is.
We're losing you.
Can you hear me?
I can now. Yep,
okay.
That's much better. So sorry.
Okay. A lot of it's dealing with the pandemic. They're trying to keep things.
Fading out again.
We're having major problems here today.
We started a little bit late because we were trying to get everything hooked up and wired. So it's just a little fuzzy at the moment. So
hold on.
Oh,
can you hear me okay? Or is it
just fine? Yeah.
Dang it. That's hurtful and truthful.
Oh, yeah. Sorry. Now, Melissa, you just have a big mouth, I guess. Now.
Yes. Can you hear me now? The Feds have been keeping the prices because of the pandemic.
I don't know if we need to switch sides or what.
All right, here we go.
Because you're really hard to hear. So I'm sorry, Nancy. So.
Where's your speaker? Ellen, you just wanted her to get.
Yeah, that was really it. You figured me out. So
okay. All right. Can you hear me now?
Totally fine now.
Okay. Where's your speaker on this thing?
I don't know.
It's obviously hidden somewhere. So
okay. Yes, you are correct that the Feds have been keeping the rates down for us right now because of the pandemic. They're just watching it. The housing market is still very strong right at the moment, but there is, a position that they're looking at that we're seeing that the consumers are still looking to purchase, but the housing pricing is getting out of hand. It is increasing more than it did last year. It's up almost $16,000 more per house for like a $312,000 house. So it's pushing buyers out of their comfort zone. We're looking at, yes, you asked about credit scores. We're still doing loans down to 580, but it's getting tough because there's a major cost. We really need, for the actual home buyer, they really need to be around a 640 credit score to not have to pay any discount points and to definitely know that there's no kind of overlays for extra reserves. Okay.
Gotcha. Well, actually, that's the perfect segue to the next question I have for you, and that is, should buyers pay points on a mortgage? Is there a big benefit to that? Is that something that we're seeing happen even more? I mean, the rates are already crazy low, so it seems kind of silly to do that. But when and how should buyers pay points on a mortgage? And well, what's that process look like?
Yeah, there's a couple ways that you can look at it.
Nope, can't hear you, Melissa.
Okay, clear it out.
All right, here we go. We're going to keep trading off.
I'm counting this as cardio.
Well, that works.
Okay, so there's a couple of ways you can look at it when it comes to paying points. You have a regular score 640 and up. With your conventional, your rate is always affected by your score, obviously, and also the loan amount. So the higher the rate, the higher the loan amount, the higher the score, the better the rate, because you have more to dig into the loan amount. To the rate with. Now, that being said, in that case, you wouldn't necessarily recommend buying points. What you do is you look at how much you save per month, what it costs, divide it, and see what it would take to recoup it to see if it would be a good value. Now, that being said, if you have somebody that is wanting to get into a house, average stay in a house is about 3 to 5 years for most, particularly first-time home buyers. And if they're needing to pay points to get into their house, not to get a lower rate because they want it, it may be something that justifies it's a means to an end, or I like to say it's a bridge to get you where you want to go temporarily. So what we do also is we kind of look and see how close are they to the next tier, because it's 580 to 599, 600 to 619, 620 to 639. So if they're like at a 631, we'll look at it and say, hey, is there anything we can do to jump that sucker up 9 points to get them to a 640? And if not, there's different ways we can try and price them to where maybe they don't have points. And if they do pay points, to pay minimal points. But in that case, it is something that may be worth paying points because it gets them in their home. It gets them starting to build equity. And in that case, it would be worth doing it versus somebody who says, I just need to see the lowest rate possible. And if you're just looking to get the lowest rate possible because it makes you feel good, if it's not a good value, it's kind of like buying something with a coupon that you'll never use and it goes bad in your refrigerator. You don't need to do that. It's just a waste of money.
Gotcha.
So we look at all of those things. You want to it depends on the person.
Great.
And the scenario.
Well, and that's great advice, because, for us personally, we know that working with professionals like you guys makes this whole process much smoother. A lot of times we have clients ask about things like that, and, we're never sure what to tell them. So thank you very much.
Well, the other thing is you'll have a lot of people that'll go, I want to know what the highest I can buy. And I'm like, do you want to go that high? Well, no. Well, then what do you need to know that for? Sometimes I know this sounds crazy. My degree is in psychology. Sometimes they just need to feel that ego, like feel that thing.
Well,
and a lot of times they just need to feel like they're in the driver's seat. So I'll tell them and I'll be like, you had told me your maximum payment was right here. This is kind of going to be in your sweet spot. Now you could go higher if you wanted to, but you want to make sure it's going to be something that you're going to be comfortable with and it's going to grow with your finances and allow you to continue to invest in your 401k, allow you to get braces for your kids, all the things that you want to do.
Unfortunately, though, where we normally see that is in new construction,
Right.
where the most they qualify for is going to be what they spend on that new construction home normally, kind of thing. So they might be, if they're qualified for 327, they're going to spend every penny to get you to 327, normally speaking, anyway, kind of thing. So.
But also, I think I had somebody that their houses that they're selling may come in a few thousand low, and now they're looking at, they had added 22,000 in upgrades. Now the slab hasn't been poured yet, and I just told them, I said, look, let's see what your house appraises for. Let's jump off that bridge, and then maybe sit down with your agent and look at your upgrades on your new house and see, is there anything that maybe is just something that if you're worried about it appraising, because then they have to pay the difference if it doesn't appraise. I said, that's something that, they haven't poured the slab yet. That's something that you can address at that time. And I think what happened a long time ago is, all of us know, during that pleasurable time of 2007 to 2000, whatever,
Right.
is that we all had champagne drinks and a beer bottle budget. And you look at all that, and then you find out, you just built the most expensive house in the neighborhood,
And when you go to sell it, it's not going to have comps because it's beautiful. But, so that's just kind of what
Now they're house poor. We always see folks who are house poor.
Yeah.
So, one other thing that came out in the news this past week is that mortgage credit availability is kind of it's at kind of the lowest that we've seen since about 2013, almost, kind of thing. So, but that's not always what we really see in reality. How tough is it right now? Is there a lot of overlays? I mean, why is the mortgage credit availability in the news as far as being available out there?
Okay. Well, we don't really have a lot of overlays, and we have a couple on our down payment assistance programs, but that's just because they're DPAs where we need reserves. That's basically the overlay there. Yes, we're seeing that a lot of buyers, it's harder. Their credit scores are, I'm being honest, typically below 640. We're getting a lot of buyers in that range. They're looking at Credit Karma and it's saying, hey, I got a 660. I want to buy a house. Unfortunately, our scoring modules are about 15 points less.
Are there targeted for a Credit Karma, which is a great thing?
I don't hear you, Melissa. Sorry.
Hello.
Hello.
My friend Nancy, she's the head attached to me.
Yeah.
No, Credit Karma, I have Credit Karma, is a great guidepost, and it's an educational score, and a mortgage score is a targeted score. So our score is usually, let's say usually because I have one or two, going to be much lower than a Credit Karma score, because theirs is an educational score to kind of give you an idea of what can drive your score. And a lot of times you have people be really disappointed because they think they're up around 670, and then we'll pull it, it'll be about 624. And so we try and be very honest with them about that and say, look, it's not that you're doing anything wrong. If your score is going up, whether it be on Credit Karma or whatever, it's going up.
Yeah. Now,
So again, that's where, we're looking at, yes, scores are really, I'm going to be honest with you, some of the lowest scores I've seen in quite some time. I mean, buyers just have not been paying attention to their credit.
A lot of people are seeing with the modifications that were offered during COVID is I don't think that some of the companies, do you believe, were forthright in some of the. Yeah, well, a lot of people, like at first they wanted to make it where, you had to wait 12 months out of a modification. I think so many people in the mortgage industry threw a hissy fit that they went, wait a minute, our bad. And then they let it kind of, because we were like, you said you would help them, not make them wait 12 months after they were out of work to make them be able to do anything for their job. So we're hoping that we're going to see not as many rental evictions and things like that. And we're hoping we'll continue to see the market steadying. I actually follow MBS Highway. I just checked, he's not out today, but I can kind of get back with you and I'll let you know what they're saying. As of Friday, they were suggesting to carefully float because the stocks were rebounding after 3 negative days, and the mortgage fund. So it kind of gives us an idea of what the market is doing on a daily basis. I follow that.
Gotcha. All right. I want to jump over in, right now we're seeing, or we've been hearing a little bit about assumable mortgages, but I'm not, we don't really see a lot of assumable mortgages actually happen. And so I'm kind of like, what is an assumable mortgage? How does it work? Which loans work with the assumable mortgages? And then how do you qualify for one?
Well, there's only two types of assumable mortgages. You got your FHA and your VA. Okay. VA is where a veteran will come in and sell it to another veteran. He'll pay him whatever equity he wants, and then he can substitute his entitlement to free up the first guy. Now, he doesn't necessarily have to give back the entitlement, but it's always nice if he does.
Now, does he have to bring that part in cash? Or can he get a second?
Well, he could actually do a second mortgage. But again, then the mortgage company is going to look at that when they're doing the assumption. Okay, because
you rarely see any of that stuff.
Now the FHA one, basically the same thing. You go straight through the servicing department. Of course, your seller wants, $20,000. Well, if your new purchaser has that, then they just give the, do the assumption of the mortgage and give the seller his money. We're seeing very little of it because most people don't have that kind of cash. I mean, our buyers are scraping together their 3.5% down payment. So we know they don't have that kind of major money. And that's why we're not seeing a lot of that.
That's normally something that comes into play, Alan, when the rates are higher and whoever your buyer is.
Right. That's really what we were expecting. But, we're kind of evaluating how effective is it to have a mortgage that is assumable today, because when you do get ready to sell, I mean, we know that these rates are not going to be where they are right now. They're just, I mean, they really are. They're at a historic low, and even the Fed said that they're going to do everything they can to keep rates. They don't care about inflation right now either. So, at some point it's going up. I know that my parents' first home was like 15% or 13%, something ridiculous kind of thing. And so seeing it, where the rates are right now, we know that they're going to go up to some point, and will an assumable mortgage be a great selling point at that point?
Oh yeah, it is definitely something I always put out there. Okay, because you may have that person that came from New York or California, and I mean they've got some money. I mean, so yes, it's still a good selling point, and if anything else, it brings a prospective buyer in to view the house.
Great.
Then also the other thing is that we're telling people right now, and I realize that for whoever's trying to get buyers in a house, God bless you, because I know there is no product out there. I mean, it is horrible trying to find a product for your client. When people are hesitating out there, we are telling them, like, first of all, not to get discouraged. I'm always tell people, I believe you find the right house when you're meant to find the right house. But secondly, your buying power is so much more right now when the rates are lower. And then thirdly, to go ahead and kind of know what you qualify for so that you feel empowered. And then also, I always tell my agents that they're welcome to give the information to the listing agent. Anything to say, I've met with them face to face. I've looked at their documents, their money is in the bank. And that way, hopefully give them some kind of edge up or leg up on the competition. Nancy, I've been around a long time, and maybe we know the listing agent. Maybe they think, hey, there's a chance that we know them, and they would be like, hey, we'll give them an opportunity because we've worked with them before. So
now will you call a listing agent and say, hey, I know you got an offer on one of our clients, they're good to go?
We do not have a problem. We don't initiate the call, but lots of times when you as the selling agent, you're like, hey, I'm using New American, Nancy Barlow Melissa Christian. Please feel free to call them. They'll go over with you. And we do have the listing agents call us.
We love that.
Hey,
on the weekend too, especially on the
That
weekend.
makes your offer so much stronger.
Yeah, I tell them to call me on the weekend. I don't care. I mean, my Jack lost 73-7 the other day. It was probably keeping me from doing terrible things to myself.
Awesome. All right. Well, thank y'all very much for taking some time. I'm sorry we've had some technical difficulties, but I'm going to jump into the rest of it. So thank y'all very much. I really appreciate y'all.
Look like an album cover.
All right.
Bye.
Bye now. Thanks. All right. So let's kind of jump into kind of, my main point for today. And that is, we got to start looking at what is our new normal right now? There was a new survey this past week that came out and said nearly half of the American workforce is not returning to the office until the mid 2021. So we got about a year before folks even are planning on moving back into, the quote unquote office. Excuse me. So, we're seeing that there really is kind of a new normal going on out there. And for most realtors, what I'm finding is that we have the haves and the have-nots here in our industry right now. We have some folks that are having their absolute best year ever, and we have other folks that are really, really struggling right now. And for the most part, it's you've got to understand that this is the new normal. This is how things are really gonna go from now on, and you have to position and put your business into where you are now and where things are really looking to move forward. So I'd like to share a few of the different things going on right now in our market. And so first thing, as far as like looking at the new normal, so the first thing is that home prices in the US tend to rise sharply in the years following a recession. Now, I know that the coronavirus quote unquote recession was kind of a blip, but still, every time that we come out of a recession, there's normally a really strong trend. If you look at the all the way back to the 91 to 96 recession, the 02 to 06, which is our .com, then we have the 2019 or 9 to 14. And you can see how over the number of the years following, we tend to have a pretty good time in the economy. At the same time, I mean, and if you look at let's break this down. In Atlanta, since the last recession, a percentage change in the median home price is up 73%, which equates to an average since the median home price since 2010 has gone up by $125,000. And so at the same time, median household income here in Atlanta is about 65 grand. So Atlanta has done very, very well. And if we continue to see, what is traditionally when you come out of recession, the market continues to do well. Right now, one of the questions that we keep hearing is, what's the market going to do? Is real estate going to crash? Are things going to fall? And honestly, I really don't feel that it is. And if you look at the numbers, they're not indicating that at all. We have a huge demand. We don't have enough supply. Things that are happening especially in the real estate market are nothing close to what it was. And especially, I mean, we always think back to the 08 in the 2010s through that whole period, when real estate was part of the reason for it. Back then, real estate, a lot of homes were heavily leveraged. Right now, a lot of our homeowners don't have so much equity out there. At the same time, we're seeing the monthly change in retail is really, really starting to move up. And even though we had a big drop, we've also had a huge jump. And if you look at where retail sales are right now, we're actually much higher than we have been. You can see the exact same thing on the monthly trend report, which is right here. And that is we've continued to steadily move up. Yes, we had a blip, but we have more than made up for it. And as a matter of fact, we're trending properly as far as it goes. The NFIB, shows that we're up about 4% from August as far as in September. And September retail sales are up 2% from August and 5.4% over last year. All right. So that's one of the big kickers for this fall right now. Is normally fall things kind of taper off. It's a slower time for restaurants. It's a slower time for real estate. Most real estate agents are, a lot of their business is kind of tapering down, that kind of thing. Not this year, buddy boy. So things are starting to rock. Our consumer price index is, even though inflation, we worry about it, it's very, very moderate, just up 0.2% and 1.5% over last year. So it's actually under average normal inflation. We've had retail sales that have climbed for 5 months in a row now. So, probably our biggest movers is clothing and accessories is up 11%. At some point, people are going to have to start buying pants again. That'll be great. Department stores are about 10%. Car dealerships are up 4%. And so cars really help drive our economy. Restaurants and bars being up 2%. We know that that's one of the sectors that is feeling the biggest punch from the economy right now. So, that's kind of, I just wanted to be able to share with you what we're seeing on retail, as well as, this is from NAR on where we are in our recovery index. And not only have we surpassed 100%, we're at like 112%. recovered, which seems ridiculous when you put it that way. But, compared to where we are and what we're doing, we are definitely seeing a V-shaped recovery, especially in the housing industry kind of thing. Also, this past week, coronavirus mortgage bailouts fell below 3 million. Now, the biggest driver of that is because so many mortgage forbearance programs had a 6-month term on them. And guess what? We've been fighting this whole thing for, the most of the forbearances started about 6 months ago. They've run out. Now, the good news is that a lot of the folks taking advantage of the forbearance programs didn't necessarily have to have it, but it was nice to have kind of thing. Last week, forbearances dropped by over 20%. So on one hand, we're not seeing people we're not seeing foreclosures, we're not seeing evictions, we're not seeing those kind of things on the existing homes. The folks that did jump out there and take the mortgage forbearance just kind of, rode that wave for 6 months, added those payments onto the end of their mortgage. The majority of those folks are more than just fine. They've actually had about a 6-month hiatus on being able to pay, on having to pay their mortgage. It does get tacked onto your end. There is interest on there, but still, a lot of those folks took advantage of that. We're down to under 3 million people right now. And so we went from 6.8% of mortgages in forbearance down to 5.6 in just a week. So it's a big deal. I think we're going to continue to see that number fall. But at the end of the day, it's heavily going to be determined by what's going on in our economy right now. And so one of the things that is very concerning for the economy right now is jobless claims really jumped up last week. It went up to just shy of $900,000. We're really happy when we got 900,000 people. It had been dropping into the low 8s, and now it shot up almost to 900,000. So that's kind of got folks a little bit leery, and me as well, because I know that jobs is one of those things that's going to help to drive our economy. We need to have jobs. So, that for me is one of those big concerning issues right now. It is currently harder to rent than it is to buy. The renters have been rushing to the suburbs, but the challenge here has been that if you're a landlord, you have to be so selective about who your tenant is right now, because if you had any issue with that tenant, you can't evict them. We have the eviction moratoriums through the 31st or through the end of the year, and there's a lot of talk that it'll get extended again. And so if you get a tenant that is not going to pay their rent, then you're kind of basically stuck holding the bag. And so we're seeing in face of that, what our landlords are doing is they are making it so difficult. Well, and I don't mean to say they're making it difficult. They're just being extremely selective. And if you had a house to rent and you had a mortgage to pay and you had to worry that person that was going to rent your house would not pay you, so you couldn't pay your mortgage, you would be extremely selective too. And so that's kind of what we're seeing. And so for those folks that are looking for rentals, we are seeing that the rental market has really shifted heavily into the suburban areas, and just finding suburban rentals right now is really difficult. And if you do, it's going to be a barroom brawl to try and get into that. So, honestly, it's easier to buy than it is to rent right now. And that's a really great thing. I know that, yes, we have a lot of inventory issues on the buy side as well, but not nearly as much as we have on the rental side. So as that continues to move forward, that's going to be a great thing for us. As far as overall last week, 6 million renters and homeowners and mainly student debt missed September payments. Now, it's mainly the renters and the student debt that saw the biggest dip. Most homeowners we saw actually have been doing much better, but one definite point of concern that we have right now is renters, as well as student loans. Student loan debt is one of those things that is creeping up on people, and earlier when we were talking to Nancy and Melissa, one thing that they said is that people got to pay attention to their credit. This is one of those things that there's not forbearance programs, or if they are, you have to go and ask for it. There are some, but you have to ask and show need and that kind of stuff. And some folks are just not paying their student loans, and that's going to end up biting them on the rear end kind of thing. At the same time, our landlords are and a bunch of lobbyists are kind of getting into this legal battle about the eviction moratoriums. And this is one that has really the potential to be just a big, ugly mess. Because on one hand, we know that when it comes to the group that is hardest hit by COVID right now, it's renters. But the other side of that is the same as the people who are renting to the renters have a mortgage to pay. And so, there is a legal battle kind of brewing at the moment about will they be able to evict folks that aren't paying their rent. That's kind of come to the forefront because there are not as many forbearance programs to be able to help the landlord if their tenants aren't making their payments. So I am expecting this to kind of come up it's probably really going to come to a head here pretty quickly. And it has the potential to kind of be ugly and not that there's ever going to be any good news during an election cycle for sure. On the positive side, we did see a big uptick in inventory the last month. And so we are starting to see more sellers moving into the market, and goodness knows we needed it. Okay. We really, really needed that more inventory on the market, because that's going to really help us to be able to, provide for our clients. As we move through the year, I'm really expecting that we start having more and more inventory, and that's kind of the trend that we're seeing. We're seeing the inventory is lightening up just a touch, and if it'll continue to do this every single month moving forward, demand is diminishing. It wasn't down very much last week, but it's down about 2% from the week before. As far as mortgage purchase applications are down about 2%. So, the demand is still really high, but we are starting to see a little bit more inventory, and we're not seeing quite as much demand. There are going to be some normal seasonal shifts that we do see. Less people are going to buy homes in November, December than during July, but we're still in a really hot market right now, kind of thing. One of the challenges that we have is, because right now our builders are building, and I am really, really thankful that the builders are rocking it out there, okay? Because we need that inventory. But the challenge on that side is lumber prices are really starting to drive some of our builders to raise prices. Right now, increased lumber prices is averaging about $16,000 to $20,000 more to the sale price on a new construction home right now. And so we're seeing where new construction values continue to move up much faster. At the same time, we're having Nancy and Melissa mentioned it earlier, but we're having more and more appraisal issues, and that's because property values are up around 11% in the Atlanta area over last year, and then we're having lumber prices which are driving that already. At the same, but the banks, the investors, the appraisers, they're not going for the values to move that much faster than what we're seeing, payrolls increase and that kind of stuff. No one is making, very few people are making 10% more than they were last year. So this kind of growth is not sustainable. The banks know this, the appraisers know that kind of thing, but we do have some real concerns there. So my concern about, when it comes to being able to have more supply, I love that the builders are building. My worry is that we're pricing out too many of our buyers, because lumber prices on top of appreciation is really, really driving that right now. So we're one other thing that we have that is also up over last year, and that is wire fraud schemes. Wire fraud is up 13% over last year, according to the FBI. And it's almost, and that is just in real estate wire fraud. But see, what happens is folks are getting involved in our transactions, or the scammers are getting involved, and they're injecting themselves into our transactions and being involved between title and the closing attorney, the buyer, the seller, the mortgage company. There's a lot of opportunities in there for mortgage fraud, or for wire fraud, not mortgage fraud, wire fraud, to really be taken advantage of. We've seen this happen, unfortunately, again and again and again. And so I bring this up because sometimes agents get frustrated with us because we require voice authorization in order to wire funds. I know most of our closing attorneys are doing the same thing. And in today's digital age, it seems like, goodness, I should just be able to wire this easily. And while I think in theory that sounds like a really great thing, the reality of it is we're talking in a lot of cases, tens of thousands of dollars that if you do it wrong, you could lose every penny. We see, and now luckily we personally have not had, none of our agents have been hit. That's not been an issue for us, but it's in our industry. And I do know of a lot of cases of this happening. We have to be extremely diligent of that right now. We have to make sure that we're taking care of our clients as well as taking care of ourselves. Yes, our E&O insurance does have wire fraud protection built in, but I can tell you, even though that's going to help to make things better, if you can avoid having those issues on the front end, it's going to make your life a lot better. So make sure that on any emails, pay close attention to, what are those email addresses? A lot of times when the scammers, it'll be just one letter off on an email address or anything like that. Anytime that there is last minute wiring instructions or last minute changes, boy, your spidey sense should go off, because that's one of the biggies right there. Like, oh, hey, just do this now kind of thing is a big deal. Voice authorization, speaking on the phone directly to, calling to the attorney's office, that kind of thing, speaking to them directly is the right way to go. Confirm, because we're talking about a lot of money here and we can't let our clients get taken advantage of it. Do not, instruct your clients, don't wire any money until you're sure the information is correct. We have all kinds of protections in the contract and things like that, but still, at the end of the day, you want to lose a deal, let one of your clients be taken a victim of wire fraud, and everything goes south. So we got to make sure that we're taking care of our clients. I kind of want to wrap up today with, I'd like to go over 6 reasons why for sale by owners fail, even in a market like today. We're seeing that because it's such a hot market that our DIY sellers have, some of them decide that, well, goodness, the market's so good that even today, I could train my cat to sell my house. It's not a big deal kind of thing. Wrong. So very first thing our do-it-yourselfers, our for sale by owners does is they have bad pricing. They don't know what's going on in the market. They don't know where to price their homes. They don't understand what's happening in our market. So just being involved with that kind of stuff and being able to do a really true comparative market analysis on your property. For sale by owners just don't have a really good grasp of how much a buyer is willing to pay for their home in this market. And so the number one issue that our for sale by owners have is bad pricing. Number 2 is a lack of marketing. They just think that they stick a sign in the yard and it's going to go. They can post it on Zillow and it's going to go. Well, guess what? It doesn't. Rarely do they have any photos, and if they do, they're awful. Their property is really not getting exposed to the marketplace, and that's one of the biggest right there. The third big issue for our for sale by owners is that they don't have access. Or is that there's no access to the property. They don't have a super lockbox. They're having to do showings on their schedule. And then, we all know that going to a showing and having the seller stand right there is creepy. It's awkward. Our buyers don't like it. It's not It's just not a really great way to be. So showings have to happen around their schedule when they want to. And so just having the whole access problem is a real big deal for our for sale by owners. The number 4 on our list is that they don't have the ability to talk money. They don't, and there's no system. Well, most of them have not been trained on how do you really, make sure that a buyer is able to buy. What are you doing to vet that buyer? Are they really qualified? Because one of the biggest frustrations a lot of for sale by owners have is when the folks come to look at the home, they're like, "Hey, will you do owner financing?" And no, they're not trying to do owner financing, that kind of thing. But they end up finding that a lot of people who want to come look at their home are just not qualified to buy it, kind of thing. And then at the same time, the folk, most are for sale by owners are just horrible negotiators. Because they're not ready to talk money. The folks who end up buying a lot of for sale by owners are really good at negotiation. Our average for sale by owner is not very good at negotiation, so they tend to get taken care of, taken advantage of in a lot of times. Our 5th biggest problem with our for sale by owners is that they don't have realistic expectations. They think that because they read in the news it's a seller's market, that just kind of gives them, a free ticket to just like be unreasonable about what it takes, what the process is, and how it all happens. The last biggest problem is that a lot of for sale by owners are trying to avoid agents. And let's face it, we have the clients, our entire business is built on trust and building relationships with those clients, with our clients. And so when we have a for sale by owner and they're trying to avoid agents, yes, I understand that they're trying to save money, but in most cases, there's at least going to be one agent involved in the transaction. And I don't know about you, but if I'm representing the buyer, well, I'm not representing the seller, and I'm not here to do your paperwork for you, and I'm not here to protect you. I'm here to protect my buyer. And so because they don't understand that, they think they don't understand what the fiduciary interest is. Like if I'm representing the buyer and you're the for sale by owner and your appraisal comes in low, am I going to help you? No, because I represent my buyer. A lot of times, they think that they're saving just tons of money, and really the majority of for sale by owners at least have one agent involved in the transaction. And by the time it gets all the way through, they really are on average costing themselves over 5%, because the average for sale by owner sells for 8% less than if they had an agent. But there's normally one agent involved. So that leaves about a 5% swing is what the average for sale by owner costs to list and sell their home themselves. So I know that in today's market, we're seeing a lot of folks who think that that's a really great time to be, a really great way, that you should go out there and do it. But then they get into the reality of it and they see, man, oh man, there's a whole lot that realtors do and agents do. So make sure that we're explaining that. Go out and engage and talk to these folks, because right now we really need that inventory, and these folks would love to sell their homes. So I hope today was a helpful meeting for you today. I know we were a little bit late. We had some technical difficulties on the front end, so I apologize about starting a few minutes late, but it was great having Nancy and Melissa with us. And if I can be of any service, please call, text, smoke signals. If you would also say a prayer for my father-in-law. My wife is up there with her dad up in Indiana. And so, we got family issues happening right now. So say a little prayer for them, and I appreciate y'all. Y'all have a great day. Thanks now.